This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Now let's get to that chart deck. Listeners, you're going to find the download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Brent's picture that says Looking for the Downloads. Now, Eric, let's cover crude oil, starting with the EIA inventory data.
EIA printed a massive 10.6 million barrel drawdown that has erased all builds on inventory which had occurred year to date previously. Cushing, Oklahoma drawing down 1.5 million barrels, gasoline drawing down 214,000 barrels, distillates building 1.2 million barrels, U.S. production ticking up another 100,000 barrels to 12.8 million barrels. That's a new post-COVID high, and it also is an indication that we're seeing a sustained move above the previous plateau around 12.3, 12.4 million barrels, where we were stuck for probably 7 or 8 months. I bought the dip, but only nibbled on this. I was waiting for a retest of $77 WTI in order to really lever up on my long position. Maybe I missed the bottom already. We'll see. I don't think the really big upside comes until next year anyway, so I'm not rushing too much here to chase this market. If we do get that dip to 77, I'll be adding to my longs at that point.
Eric, when looking on page 2 at that crude oil futures chart, I have that 50-day and the 200-day simple moving average on there. And when oil broke out and got back up towards its first quarter highs, we obviously had the price action pause, and it retraced back toward that 50-day moving average. But overall, the price action has been relatively good and accumulative. What I want to look back is to the end of 2020 and the start of 2021. After that bloodbath in oil, you saw the crude oil prices consolidate back above these moving averages, and it became the beginning of a 1.5 year bull run in oil. Now, it is incredibly premature for us to already assume something like that is happening, but we've now spent over a year consolidating and backfilling and correcting in oil and spending a lot of time below those moving averages. And this is the first time after that deep correction that we're seeing oil doing some constructive price action. If we see all of that resistance level that was established at the top end here in this $80 to $82, $83 area beaten in the coming weeks, it may be a sign that some bull continuation pattern is getting underway.
Patrick, with Nick off this week, I want to turn our post-game segment upside down and interview you on some option strategy questions that I've been mulling for the sake of my own trading. Specifically, I remember reading about the cheapest left tail hedges of all time on Zero Hedge about a month ago. I've been kicking myself ever since for not taking advantage of sale prices on left tail hedges back at that time. Now that we're seeing the market push back up toward its prior highs, I want to start with my first question, which is, do you still think, as you alluded last week, that we're in some sort of topping process on equities?
Eric, yeah, I still will stand by my view that we're in some sort of a topping process. When looking at that chart on page 3, I've highlighted the previous corrections that were often in this kind of 200 to 400 point 5% variety of corrections. And this pullback that we just had looks like a cookie cutter of all of these in the past. And generally, with this type of a bull reversal that we've seen over the last few trading sessions, it leaves the window open for retesting highs or even potentially breaking slightly to a higher high. And I think a reference point that I think is a really interesting way of comparing this is if we look on page 4 to the S&P 500 chart through the period of 2005 to 2007. So obviously, when looking rear view mirror, we know that that was the period right before the great financial crisis. We knew that Greenspan and Bernanke raised interest interest rates into the middle of 2006, over 4%. And we started to see cracks in things like subprime in early 2007. But you can observe that in spite of a lot of these warning signs, the market would have these corrections and then proceed to make higher highs. Even in the summer of 2007, when there were a number of these Bear Stearns subprime credit hedge funds that were blowing up and needed to be bailed out, the market still turned around and managed to make a higher high in October of 2007 before the bear market began. And so I really just want to step back and reflect on, well, just because we know that the Fed is slowing this economy and that it could lead to a recession and that inevitably something breaks in that, it doesn't mean that the market can't stay up here longer than people can expect. And while I do think that there's a high vulnerability to inevitably a deep market correction to inevitably turn its head, maybe Darius Dale will be right with, the recession coming in fourth quarter, first quarter of the upcoming year. Maybe we'll start seeing the market start to care at some point. But at this stage, I think a topping formation where the market fakes out bears and then fakes out bulls and creates maximum confusion up here is still the path of least resistance and likely to happen.
Now tell me about the value proposition of options-based left-tail hedging strategies in terms of how the premia for those strategies compares with historical norms for the cost of similar hedges.
Yeah, well, a month ago, we were doing that special webinar for MacroVoice listeners where I was talking about buying insurance, which was incredibly cheap in the markets from a put perspective. And I was explaining why during the webinar. I know a whole series of our listeners took advantage of that. So congratulations to them. Now, I wanted to, though, kind of create the backdrop of understanding where we are on this. So I wanted to, on page 5, talk about where we are on volatility premium. And so here I took not the 30-day VIX that most people are used to looking at, but I wanted to look at a one-year volatility index because when tail risk hedging, you often want to go with a little more duration rather than rolling hedges every single 30 days. And so what you can observe here is that we are at multi-year lows even after this correction over the last month on one-year volatility. We obviously are not back to 2019 lows, but I'm not even certain we will get that low in any sequence, even if the market does rally back to its highs. And so we are, at least on a volatility premium basis, on the low ends of the spectrum of cost. The other thing I have a chart on page 6 is the CBOE volatility skew, or the skew index. And we are trading at the upper boundaries of the typical range of the skew. And this means that option left tail skew does exist. And so while buying insurance on the markets is cheap on an implied basis, it does steepen and it is more costly when you're going and buying left tail insurance as you're going 10 or 20% below the market. It is got steepness to it, but there are option strategies you can use to overcome that. And so we can talk about some of the different things in terms of the ways that one can hedge. But the last point that I wanted to make before we move on is what is driving an additional kicker that causes a lot of this insurance to be cheaper than before, and that is essentially interest rates. One of the discounting mechanisms in options pricing is interest rates, and the sensitivity of an option to interest rates is option Greek known as rho. And what we have is a period where we are at these 5+% interest rates that have to be discounted into these options. Particularly, the longer dated options are more sensitive to this as they are discounting more and more interest rate in it. And so the fact that we have the interest rate environment we are in, that generally is making call options more expensive and put options cheaper. Now, that is inherently a function of option pricing, but that's certainly for someone who thinks that the market here is vulnerable and wants to buy downside hedges. It makes it that much more attractive to be buying some of these puts to buy some of that downside protection.
Okay, now I want to expand the conversation and explain why I'm so concerned with hedging broad market risk in the stock market, considering that most of my trading focuses on commodity futures, which are a completely different asset class. The reason is that I'm extremely bullish on uranium miners over the next 5 to 10 years, and I want to establish a very significant position in that space. But look, similar to junior gold mining shares, uranium miners and uranium mining juniors in particular are famously over-owned by retail investors, meaning that a crash or sudden correction in broader markets could easily bring on a margin call that wipes out over-leveraged retails. So I'm not about to lever up my holdings in junior mining shares unless I have a solid hedge in place to cover the scenario where, despite the fundamentals remaining strong, the uranium mining sector takes a nosedive for all the same reasons that junior gold miners have been clobbered in past broad market sell-offs. Now, to be clear, the reason I'm asking about cheap left-tail hedges on the S&P is because there's so much liquidity in those broader markets, and because rumor has it that hedge premia have recently traded at historically unprecedented discounts. I also think that your answers on that topic are going to appeal to far more of our MacroVoices listeners, and that's the real reason that I asked that question first. So let's start off with how attractive or unattractive broad market hedges are at the moment and what the best vehicles are to put them on with. Please answer that first, and then we'll come back to whether a more direct hedge on uranium mining would make more sense given my trading needs.
So, Eric, I think that it is relatively attractive still, but because of the skew, it generally is, in my opinion, more favorable to be expressing downside hedges through spreads that are removing very specific parts of the downside risk. So let's just build a few scenarios to give an example. So let's say you are bearish in the second half of this year, and you want for the remainder of this year to build some sort of a hedge that kicks in on the left tail once the market is down greater than 5% from the current level. And what you want to do is remove the downside risk, or at least create a hedge that is going to give you protection for a 20% decline in the markets this year. And so you're basically having that hedge kick in 5% below the market and hedging 20% for the remainder of this year. Something like that costs you under 0.5% in terms of the notional value of what you're trying to hedge. Now, at the same time, let's say you were even more bearish and you believe, let's say, that the risk is over the next 1 year. And so you're taking an S&P hedge that you want the left tail insurance to kick in if the market drops greater than 5% from where the current levels are, where S&P is right now around 4,500 at the time of recording. And you wanted 25% downside protection. So that it's protecting a 25% market correction on the downside. This type of a hedge is going to cost you over 2% of the notional value of that you're trying to hedge. And so there are choices for you out there. I think that that's a reasonable cost for somebody who is fully invested and or even leveraged on the upside of the market and wants to have some degree of protection to ensure that if the markets did start getting ugly, you had a way of protecting yourself on that downside. But also I wanted to highlight just a very basic strategy, which it may not apply to someone trying to hedge a uranium portfolio. But one of the things, because of that interest rate factor that we talked about in terms of interest rates causing calls to be generally more expensive and puts to be generally cheaper, this actually allows the collar strategy to be more attractive than it was in the past. As an example, if for the rest of the year you wanted to create a hedge wrap where you said, I want the upside of the market all the way up towards 5,000 on an existing position in the S&P, and yet I want the hedge to kick in on all downside risk below 4,000. If for the rest of this year, you're talking about outlaying a debit of just under 20 S&P points to be able to put on that trade. Now, what's interesting is that if you go farther out and construct that same collar, because interest rates become a bigger factor on longer dated options, you actually can create a 5,000 upper boundary and a 4,000 lower boundary on a collar on the S&P 500 going out 1 year to August of next year and actually receive a 25 S&P point credit. You're actually paid to have this type of a hedge on. Now, of course, if the stock market goes ripping north of 5,000, then you're forfeiting a certain amount of returns. But if in any way you feel that the stock market has only limited upside, these become very reasonable ways to put on some protection.
Okay, now let's come back to my actual trading situation. I'm proud to say that I did a great job of timing the April-May low in mining shares. That, plus my trusted copy of Uranium Insider, which is our friend Justin Hune's newsletter, allowed me to establish my first tranche of uranium mining shares right on those spring bottoms. But fearing broader market weakness in coming months, I only started with 10% of my intended final allocation in this first tranche. Those shares are now up 40% in the last few months, which is great, but that also means they could very easily go down more than 40% if we get a bear market resumption, as so many of our macro guests have predicted. I'm convinced that we're still in the very early innings of this uranium bull market and that we're headed toward much higher numbers. So I don't mind adding to my longs, even up here after 40% of upside that I've just seen after those April-May lows in some of the stocks I bought at that time, but not without some kind of efficiently priced hedge. So please help me design one.
Well, Eric, the idea of adding an S&P 500 hedge on a basket of uranium stocks is assuming a liquidity event, because even if we had a 20% market correction, if it was more systematic, it might just involve sector rotation and the Magnificent Seven having a sell-off, and it may not stem into a liquidity event where the correlation of all assets go to 1 and everything is dropping as the market is just nosediving. So really, if you're overlaying S&P 500 hedges to a uranium basket, stock basket, then you're really only hedging that liquidity event, which is that something, shit hits the fan and things really get out of hand, and this is going to help blunt the downside. One of the things you could do is simply consider hedging using the uranium ETF, the Global X Uranium ETF, which is a symbol URA. Now, you can go out there and let's just say you said that what I want to hedge is the downside risk of uranium correcting more than 10%. And I wanted to hedge out up to a 30% decline in uranium stocks during an event like this. And so again, using a spread trade that would kick in 10% below where the current uranium market is and hedge out a 30% decline in uranium, you're talking about a $1 outlay on the ETF, which equates to just over 4% in total cost. Now, 4% is a little more expensive than the numbers we were talking about on the S&P, but the correlation will be much stronger as your real uranium mining stocks will genuinely be going down in a period where the URA hedge is building intrinsic value. And when you're looking at a scenario where, on the upside of these uranium plays, you're probably talking, 3-digit returns on the upside when this thing goes ripping, paying 4% to have a tail risk insurance that allows you to hold through a downside correction may be a reasonable way to put on this hedge when you have such distinct concentration in just one sector. Nonetheless, Eric, let's move on to page 7 where we have that US dollar index. What are you thinking here?
Needless to say, Brent's perspective is sobering. I don't feel qualified to really have an opinion one way or the other on whether the Dixie could move to new higher highs above 115. But I will go on record as saying authoritatively, right here, right now, if that happens, it's going to break a lot of other things, starting with EM debt. Coming back to the near term, the test of 104 that we just saw was super important. So far, it's rejecting back lower, but that was only the first attempt at taking out the very important technical level of 104. Whether the downside rejection continues or if we see a successful breakout above 104 is going to be the big tell that tells us where the next leg is going to go. So far, it's pointing towards staying in the consolidation range rather than breaking out higher, but it's still too early to call it either way.
Yeah, well, for me on this chart, we just continue to find overhead resistance in this 104 to 105 level. And until we see a genuine kind of a driver that creates a risk off in the broader markets, then in my mind, we are in a situation that genuinely can have the US dollar just stay in this trade range on the short term. But it will probably inevitably be a big signal when we have a bull breakout above this resistance that's been establishing itself all year long. So let's see how deep this correction goes and where the bulls can dig in. All right, Eric, let's move on to uranium. On page 8, I have that Sprott Physical Uranium Trust. What are you thinking here on uranium?
To understand it requires first understanding the legal structure and the mechanism of operation of the Sprott Physical Uranium Trust, known as SPUT, which is the most common vehicle for holding uranium. Because they buy physical metal, their buying can actually be a big factor in the market. But the rules of the game say that SPUT never buys physical uranium when it's trading at a discount to NAV, as it has been for several months. So SPUT has not been an active buyer in this market. That means all the guys who bid up SPUT shares in the last few weeks bought their interest in the trust's existing uranium holdings from other guys who already own SPUT shares that they were willing to part with. But if continued speculation on the long side of SPUT drives its price to a premium over its net asset value, that will allow the managers of SPUT to begin buying more physical uranium on the physical market in order to add to the trust's coffers. This transition from below NAV to above NAV trading on SPUT has happened before, and the uranium bugs are all getting excited that it's about to happen again. So that means that there could already be some speculative interest wound up on the long side of the market already. Of course, anything's possible, but there may be a setup for an acceleration of the bull trend if SPUT breaks out to trade at a meaningful premium over NAV. More buying of SPUT forces more buying of physical uranium by SPUT, which drives the market price up, in turn driving more speculative interest into the long side of SPUT, and it all turns into a self-reinforcing virtuous cycle.
Yeah, Eric, it's very bullish that Sprott Physical is getting back up to its previous highs, but that uranium U308 spot price is still a little away from that $64 high from 2022. But I remain relatively bullish here. But what is interesting is when you look on page 9 and see Cameco, which is one of the largest uranium plays that is available on the markets, it was a very clean and bullish breakout. And at this stage, obviously, there will be short-term corrections along the way. But it really does look like this uranium story is working very well. All right, let's talk some gold.
Well, we're up $70 off the lows, so the fact that we have a new bullish impulse that's hit the market cannot be questioned. What we can debate is what the fundamental catalyst was to launch this move. The world moved a step closer to nuclear war last week, so it could be argued that the security concerns in the wake of Prigozhin's killing are driving the strength in gold. But frankly, if there's anything we've seen since the beginning of the Ukraine conflict, it's that gold has, for the most part, ignored geopolitical risks and is traded mostly as an inverse dollar proxy. As of Wednesday afternoon, we're trading right on the 100-day moving average at 1972, and a break above that level could be argued from a technical analysis perspective to mark the end of the correction.
Yeah, generally, just the way Brunt alluded to it, it's pretty bullish the way gold has generally held up. I mean, if you really look at the rates markets and you look at the dollar strength, one would think that gold could have been much more vulnerable on the downside. And yet the corrections, while we certainly had some, did no major technical damage. Just as an example, I have that 200-day moving average on there, and we're corrected to it, but it certainly hasn't done any violations of the trend. And this is where I think we can generally maintain a bit of a bullish bias on that. But what I wanted to just leave with here, Eric, was just touch on that 10-year U.S. Treasury note futures on page 11. And we had a direct retest. I put this on a weekly chart so you can really see that huge bond bear market we had in 2021 into 2022. And really, we retested this low. And I kind of step back and ask on a macro scale, when we have the Fed having done what it's done, inflation already well off of its highest levels, and a lot of initial readings on things like PMIs already showing economic contraction, is this an environment where we can have long-term yields make considerable moves higher? And under my opinion, I think there's a reasonable chance that these lows will hold. Now, that doesn't make me super bullish bonds, but I don't necessarily think that the risk of a big breakdown is as high as a lot of the pundits out on the Twitterverse are suggesting. It'll be interesting to see in the coming weeks whether or not we make it back to that 50-day moving average, and that this becomes far more of a basing formation than a major downtrend.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.